Hello and welcome to another episode of Your Retirement Planning Simplified. I am Joe Curry, and as always, along with me, my co-host Lindsay Wilson. How are you, Lindsay?
I'm great, Joe. Just midway through client reviews, and again, pleasant to see everybody and get caught up. So it's been busy but great.
Yep, lots of fun. Always good to catch up with everybody. As I was telling one client today, I feel like now my life is basically visiting with clients, which is great all day, and then going to a hockey rink after and
Yeah, that's
rinse and
right.
repeat.
Because yeah, Lou and Harry are playing hockey, and then Lou is also doing rep baseball too, right?
Yeah, so thankfully that's taking a pause now until January. So they'd had
Mm,
some fall practices, but now it's getting too dark too quick. So
mm.
yeah, we can wait till January and then we'll go indoors.
Okay. Okay. So
Yes,
a bit of a break on that front.
yes, which is good
Yeah.
timing.
Yes, for sure. Yeah. So today we're going to continue on with our exploration of the RISA framework, and we're looking at the Risk Wrap Quadrant today. So we'll be diving into the Wrap Quadrant. That's quite a tongue twister.
It is a
Um,
bit.
what exactly is the Risk Wrap Quadrant all about?
Okay, so this is where people are seeking a balance between the probability based investing, so that total portfolio return or total return we talked about in our first segment. So they want to get that growth potential, but they also want to balance it with some protection that can sometimes come if you're willing to commit. So not being afraid of commitment. So, these are people who you want to participate in market gains, but have some safety nets in place really to limit potential losses. So you can think of it kind of as like a hybrid strategy, blending risk taking of total return with some security features of the income protection quadrant.
So to continue on, how does someone implement a risk wrap strategy?
Okay, so this strategy, so often and most often involves a product like a variable annuity. So in Canada, more specifically, Guaranteed Minimum Withdrawal Benefit or GMWB. So when we think about the RISA quadrant, I just want to back up a little bit. If we're thinking about our quadrant, the risk wrap section is going to lean in preferences towards having exposure to probability based investments. So those are our normal market, stock and bond investments. Um, and also having a preference or being okay with a commitment in order to have some predictability in their future income. So if I go back to, I was talking about that guaranteed minimum withdrawal benefit or the GMWB, that allows retirees to invest in the market, but with the insurance that they're going to receive a minimum level of income. So even if those investments underperform, so they don't do well or markets are bad in general, they still have a guaranteed level kind of minimum income. So to go into a little more detail on what that looks like, with the GMWB, kind of step one is you deposit your money or transfer your money into the GMWB, just like with any other investment. So that could be an initial lump sum. So you're just writing a check, putting the money in as you're approaching retirement. It could be transferring in other investments you already have from other accounts. And then as you approach retirement, so if you're doing this a few years out from retirement, you can continue to save into these products just like you would save into any other investments, like on a monthly basis or with lump sums. So the second part is so once you have your money in there, you need to decide how you're going to invest it. So from a list of available investments that whatever insurance company, I should maybe back up, this is an insurance product. So you're working with an insurance company to put this in place. So each insurance company who offers a GMWB is going to have a list of investments that you can choose from. So you're going to pick the option that makes the most sense for your situation, whether that's you choosing it or with the guidance of an advisor. Now, the insurance companies are typically going to limit the amount you can invest in stocks or equities. So that, for example, might be, you can invest however you like up to a maximum of 70% stocks, for example. So you're going to choose some combination of stocks and bonds and maybe money market type funds, or possibly, depending on the insurance company, again, the options might include some pre-built asset allocation portfolios where maybe you pick the growth or the moderate or the conservative portfolio. So once you've done that, you've added your money to the product, the amount of money that you initially put in there is going to give you a guaranteed amount of income when you need to take income. Okay. So for example, if you put your money in at age 60, as long as you leave that money that goes in is going to determine your initial guaranteed amount. And then if you leave money in the contract, so you're not pulling money out, then they're going to pay you a certain amount of income for life, regardless of what the investments do. So, for example, maybe that's 4% for life of the initial amount that goes in there. So, while you're not restricted from taking more than the minimum amount, so again, that minimum guarantee, to say it's 4%. It's not that you can't take more out than that, but if you do, there's going to be penalties when you start taking in excess of that guaranteed income. Okay. Now, there's ways to increase that income over time. So another benefit of the GMWB is that you can increase that guaranteed income in a couple different ways. And this is specifically while you're leading up to retirement generally. So the first way is, regardless of your investment returns, the insurance company will provide a bonus to the amount that was originally used to calculate your guaranteed income. So for example, let's just say you put in $100,000 and you leave it there for a year. You haven't added any money. It doesn't matter what the investments have done, but the insurance company will give you like a 5% bonus to add on to that initial $100,000. So say $5,000. And so now, because you didn't take anything out this year, they gave you the bonus. So now that 4%, instead of being based on the 100,000 you put in, it'll be based on the $105,000 that you have in there. And again, if you wait another year, they'll give you another bonus 5% that goes in there. And that's not money they're giving you to be able to take out later as a withdrawal. So let's just say that you want to wrap it up and take it out. You don't necessarily get that money. But what it is doing is it's just increasing the number they're using to calculate what that guaranteed minimum income is. Mm-hmm. Now, aside from adding more money to the account, the other way to increase your guaranteed income is through investment returns. So remember, we talked about actually investing your money inside this product, right? You chose your investments and hopefully it's growing. So every few years, the insurance company is going to review the market value of the investment in there. And if it's risen more than what those bonuses are that I just talked about, then what they'll do is they'll lock in that new value and they'll use that number to calculate the guaranteed income going forward. So for example, let's just say with bonuses, if you got up to like $118,000, but through market growth, you were at $125,000, that's the number that they'll lock in after, say, the 3 years. And they'll use that to calculate that guaranteed income going forward. And they'll do that every few years. So every contract could be a little bit different, but that's typically how it would work. Okay. And then even if markets are doing really well, when you actually start taking money out of the GMWB, that could potentially still give you a bump up in that guaranteed income if the investments are growing enough. Mm-hmm. So the next piece of this is, we've talked about putting your money in, investing it, the bonuses that come with it. But at some point when you retire or you just need income, you can start taking the withdrawals from the GMWB. So the age at which you start your withdrawal is going to determine the payout percentage you receive for life. So I mentioned 4% earlier. So let's just say that it was 4% if you start taking an income at age 65. If you take it earlier, it's going to be a lower percentage payout. If you delay it longer, they'll give you a higher amount. But they're going to tell you, based on the age you're taking that, this is the amount you're going to have guaranteed for life. So as you take those withdrawals out of the portfolio, your investment value is going to reduce because you're taking money out of the account. However, your guaranteed income is not going to change despite what happens with your investment performance, right? So even if the investments you've chosen there tanked and they went to zero, you're still going to get that guaranteed payout for life as long as you don't do something to kind of blow up the contract, like you took a bunch of extra money out or some other scenario. But as long as you just stuck to the guaranteed income, you'll get that for life. So one of the bonuses here over an annuity is that if you were to pass away and there's still market value in that investment, your beneficiaries are going to receive the market value of the remaining investments. Unlike the typical annuity where if you pass away, then your beneficiaries aren't getting anything. So the key idea behind this whole thing is you're still exposed to market gains. You can still benefit from that. But if things go south, then you have a guaranteed income floor to fall back on. So bringing this all back together, Lindsay, where does the GMWB fit into your plan if you have a risk wrap retirement income style? It's somewhat like an annuity, as I just mentioned. So there's some income protection there, right? just like we talked about in our last episode, the income protection quadrant. So you might use a GMWB in tandem with other guaranteed benefits like pensions or government benefits that you're going to receive in retirement to ensure you have that income floor to meet your basic expenses. So again, same idea as the annuity, how you might be using this. It's just you're probably giving up a little bit in the guaranteed income in order to have some of those other pros or cons, I guess you could say.
Yeah. So I'm curious, who typically fits into the risk wrap quadrant?
Sure. So I guess this is kind of a recap to what I said earlier, but you fit into the risk wrap quadrant if you understand the value and the potential of investment returns, but you're still nervous, a little too nervous to bank your required income for life on the performance of that traditional total return portfolio. So you like the idea of guaranteed income, but you don't want to miss out on some of that market upside and the flexibility to take out money in an emergency if you had to, and as I mentioned, the ability to leave excess funds that aren't spent to your family.
And like we've done previously, I think it'd be a good idea to explore the pros and cons of risk wrap.
Sure. So I mean, I think when we talked about it, the pros are pretty clear. Like it does sound pretty good, right? So there's growth potential with a safety net. You're not entirely at the mercy of the market, but you can still benefit from the gains. So it's also a great way to mitigate sequence of return risk, which we've talked about on the podcast. And you can look more at past episodes if you want to learn more about that. But sequence of return risk can devastate a portfolio in the early years of retirement if markets perform badly early on, right? So those are all some pretty clear pros. However, there are some significant cons here. So one is like these are complex products. Okay, so every insurance company is going to have some nuances in their contract, and you're going to want to make sure you know the differences between them and how that might affect you, just to make sure you understand things like, can the guarantee change? Can fees go up? Can they limit your investment options? So there is some complexity to this. The biggest one is probably the cost. Okay, so guaranteed income with growth potential sounds great. But as you might guess, insurance companies are not in the business of losing money. So the fees for these products are typically significantly higher than what you're going to pay for your traditional total return investment portfolio. And kind of piggybacking on that cost or fees is the penalties. So if you need to take more money than the guarantee, then you're going to pay for it. It's going to cost you an additional fees in the form of withdrawal penalties. And then beyond that, there's investment restrictions. So again, while the opportunity for market growth is a pro, you're not going to be, or you're going to be restricted in your investment choices to what the insurance company makes available. So in other words, you're most likely not going to be able to choose a low fee, evidence-based investment portfolio, which we talk a lot about on the show, Lindsay. And there's also a good article that explains these GMWBs at getsmarteraboutmoney.ca. So we can include that in the show notes, Retirement Planning Simplified.ca. But anyway, it does a good job of highlighting some of these points that we just talked about. So I think those are the key pros and cons, Lindsay.
Right. So as we begin to round out our exploration of the RISA, what can we look forward to in the next episode?
Okay, so we'll be going into our last episode in the series. So episode number 4 is going to be on the time segmentation quadrant. So this one's all about creating different buckets. And we've talked about buckets on the podcast before, about creating different buckets to match your income needs based on the timeline for requiring money. So you've heard me talk about a defense bucket for that short-term spending and income requirements, and an offense bucket for your longer-term kind of future retirement spending. So we'll get into the details of that and how the buckets can give retirees a peace of mind while balancing the risk and reward that comes across total return investments.
Excellent. All right. So next week, time segmentation.
Yeah. And I guess maybe, Lindsay, we should just, as we have in the last few episodes, remind people that the action item from this is, if you haven't already, it's to do your own retirement income style awareness assessment. So you can email us info@retirementplanningsimplified.ca and just let us know you want the assessment, and Lindsay will send out a link. Or you can go to retirementplanningsimplified.ca and find this show or any of the RISA series on our, I guess it would be under the blog on the website, and we'll also have the link in the show notes.
Great. Thanks,
Awesome.
Joe.
Thank you, Lindsay.